Hello, everybody. Very sorry for this, this problem that we faced. I think Kishore Bhai will come, log in again and come in some time. Meanwhile, we can start this spaces. Welcome everybody to this BW spaces on the stock markets. We have seen a sharp fall today after a long time, where Sensex and Nifty have crashed. But basically, there were two reasons today for the crash. One, of course, was dictated by SEBI and the mutual fund body to the mutual funds to protect the interest of small investors uh, in the wake of the fraud that is building on in the small and mid cap stocks. Before we go ahead, I'll introduce you to the speakers. We have Rohit Srivastava, who needs no introduction, who is a well known name in the stock markets, and he has been predicting stock market moves with a high probability of accuracy, a high probability of getting it correct and the accuracy. And we have Sarvendra, who has worked with many stockbroking firms and he's an independent investor now. Both of them have been extremely bearish on the markets for a few months now. Last spaces we had in January, both of them were extremely bearish on the markets. But Nifty has not been showing us any big moves. It's a 500 point fall, 700 point fall, and again it goes back towards those high levels. So today's fall actually, after market closing today, I got call from several stock market, big stock market investors as to what is happening. My sense that I get after talking to a lot of people and also people in Delhi is that, uh, you know, there is a sense within the government that the market is, there is a froth in the market and small and mid cap stocks have gone up sharply. And they do not want any negative sentiment going into the elections or during the polling time of elections or when polling is happening. So I think hence this kind of a measure by SEBI to announce to tell the mutual funds to protect the small investors and amphi and all. So I think somewhere there is this realization that markets, too much of speculation needs to be stabilized. The other reason is this open interest in the future segment went to 4 lakh crore, which is a lifetime high. I mean, something like this, we did a story today in Business World. Something like this happened in 2008, 2019, and 2010. Stock markets fell badly. So this time we got to see where really it is going. And one more reason is, I was talking to Kishore Bhai, who's an extremely good investor and analyst of small and mid cap stocks, and he's been tracking markets for many years now. He tells me, looking at Nifty price to earnings, which is 1 year trailing is at 19, and the 33-year average is at 25. He doesn't feel there is too much of a froth in the market. In fact, people are just getting nervous, and there is a fear in the market just because stocks have gone up sharply, but and mostly PSU stocks. But for many years, PSU stocks haven't rallied. And so what if they have rallied for, if they have doubled or tripled? And of course, the markets are going to have some kind of reaction after they rallied nearly 15% since December, when the state election results came on, I think, 5th or 6th of December, where BJP won 4 states. So 15% rally in the main indices, and stocks also rallying even more sharply is going to have some impact. And in the short run, people are going to take the profits or take the money. But you know I have been covering stock markets for nearly 20 years now, and the kind of leverage and the kind of froth that we used to see when margin rules were not so tight in the past few years, SEBI has tightened the margin rules, and hence the kind of froth that used to build up in the derivative segment may not be there, because for everything there is upfront margin. If you want to buy cash market, you have to pay the money upfront. So that kind of blind kind of speculation which you may see is not there today in the markets. And hence I believe that there is too much of fear at these levels, and psychologically, for the markets to go down. I mean, it'll take something more than just this kind of a fear. So I think I'll invite Rohit to talk, and then we can take it forward from here. Rohit.
Thanks,
I have
Palak.
joined.
Yeah,
Yeah,
Kishore Bhai is here. Great, great, great. Kishore
Yeah.
Bhai is here. So he is extremely so. So I'll tell you, I'll tell everybody who is logged in and the listeners that Rohit and Sarvendra are extremely bearish on the markets, and Kishore Bhai is another extreme. He believes that the rally is going to continue for some time now. So this is where we stand. So anybody, I mean Rohit or Kishore Bhai, anybody can go first.
You want me to go ahead first?
Yeah, Kishore Bhai, you can take it. Yeah.
See, every
Kishore
day.
Bhai is, one second, Kishore Bhai, I have not given you a proper introduction. Kishore Bhai is known as the king, Raja of small and mid cap stocks. His analysis of spotting those gems is very good. And so I have seen in these many years. So Kishore Bhai.
Yeah, every dip is considered as a bear market. We have seen this in 2008. We have seen this in 2011. We have seen this in 2015. We have seen in 2020, and we have also seen in 2022. 15,700 was 15,400 was the end of the market, but we reached 22,000. So market has its own course of action has to be followed, and some corrections cannot be considered as end of the market. Yes, March will be a month of correction simply because margin funding is closed. A lot of adjustments always happens in the books of accounts. The tax consideration also comes in. So current fall is nothing but a small dip. As far as market is concerned, the long term is absolutely stunning, and I think market is heading almost double from here. Now, why? The very important reason why market is bullish is the price earning ratio. There has to be some methods on which we have to value market. A lot of people say that the valuations are excessive, market is overbought. But what is that valuation? How do you decide whether markets are overbought or underbought? There are two methods of valuation. Globally, people like Warren Buffett follow market capitalization to GDP. And secondly, a normal concept is price earning ratio. Now, India's 33 years average price earning ratio is 25. 33 years. The record of 33 years cannot lie. And if you take 10 years average, it should be 26.5. And it has seen a high of 42 price earning ratio. And currently, 1 year forward, because this year is anyway ending, we have entered in March, so there's no point in talking of March 24. March 25, the trailing price earning ratio is 19. Now, if you consider 19 and 25, we are currently at a steep discount. Therefore, expecting market to fall big from current price earning ratio is just impossible. Yes, some dips will happen, some corrections will happen, but market has to go up. And if you go on a market capitalization to GDP also, our market capitalization is $4.1 trillion and our GDP is around $4 trillion. So we are comfortably placed at around 1 ratio as against a 10 years average of 0.92. And if we give that premium of current liquidity, this premium is nothing. In 2008, we had reached 1.49. In 2020 also, we had reached 1.42. And 2022 also, we had reached 1.20. So considering these methods and valuation, the markets are comfortably placed. Therefore, I still feel that there is enough scope on Indian markets as far as large caps is concerned, as mid caps are concerned, and small caps are concerned. What is important is stock picking. Now, if somebody want to say I will buy BEML at 3,300 and make money, then it is a difficult call. But when I issued a buy report in BEML few years back, it was 300 rupees. The stock has become 3,000 rupees. So what is important is stock picking. Enough opportunity to pick your own stocks. So as I discussed, considering the price earning ratio, which is lower than US price earning ratio is 22. There is no scope that we can see a market falling big way. Okay, 500 points or 700 points correction, I don't consider there's a bear market. It's only a part of correction.
Yeah, Rohit, we want to go.
Yeah, sure. So these are very interesting times, and the beauty is that the beauty of markets is that there's so many behavioral finance issues that help us set our minds in a particular way and decide that this is how the market works, that prepare us for the alternate scenario. To just give you an highlight, post 2009 we have really not seen too much volatility in these markets, and because we haven't seen, in fact, volatility management has become one of the directives, I think, of those who are coordinating market action. Whether you see it in currency markets, you see the narrow volatility in USD INR. I think RBI has made its mandate that currencies should not be volatile. But that doesn't really take away risk from markets always. It shows up at some point of time in some way. Uh, if I go all the way back to even in 1992, at the end of the Harshad Mehta bear market, if you can call that a bear market at all, my mother was trying to buy HDFC stock, and that time it was trading at almost close to 1,000 rupees. And if she did, probably it would be, I mean, she did, and it would have been, many times more today. Now, the my point of putting out that example is that at a price, stock picking does work. There's no doubt about that. But that's one stock and that's one company, and then there are many which come and go with every cycle. So when we talk about risk management, it is all about knowing that there are cycles in the market. There are ups and downs that come for some particular reason, and through each of those cycles, many companies that have gotten propped up, that we think are great in business at that point of time, don't really survive the business cycle, because in the end, doing business is different from stock market. Doing business is survival of the fittest. You're competing with other competitors. You will make it, you may not make it. The others will try to squeeze you. You might become very good at your product, and you might create a moat, yes or no. Some people manage it, some people don't. On the one side you'll have Bharti, and on the other side you'll have Vodafone. So this is what really ends up happening, no matter what the size of the company. So it's really doing business is really a big fight. And when it comes to markets, markets are really about knowing, being able to figure out those changes as well. So you know that every company you buy which you think is good may not necessarily survive the next cycle. So there are few survivors who will take you on for the long term, but what bear markets really do is they do the cleaning up act of the bad actors in every swing. And that is what you need to cut out. Now, we can follow the path of active management. We can follow the path of passive. These are all debates. They come and go, which each seasonality of periods. There are periods when it looks like active management works better than passive. Passive works better than active. But can you really call out certain phases in the market that can cause deep drawdowns and take care of them? Definitely you can. So that doesn't mean that the companies you bought may not perform in the long term. You can sit through drawdowns. You can even manage your drawdown risk by only creating a limited amount of cash. So it doesn't always mean that you want to go 100%, because after all, some long-term investors like to stay invested forever. So all of these arguments are okay in their own place. The only argument which is not okay is that the thought that you can't really know that there is froth in the market, and that there can be risk that is bigger than what we are really facing. Uh, in markets, we've even seen changes in how we approach valuation metrics. I mean, I can go back to the tech bubble. When PE ratios stop working, fundamental analysis will shift towards something else. You move towards PEG. If PEG doesn't work, then you'll move towards EV by EBITDA, and so on. My approach to markets has been complete market analysis, which means I consider technicals, I consider fundamentals, I consider macroeconomics. I believe that you need to know about everything in the market to know what is really going on. And you can, at least on the surface, know what risks are going to uh, need to be taken care of. So are we only going to see a 200, 500, 700 point correction? Then we wouldn't really call this a bubble or call it a bear market. We are only 500 points away from the top. So can we really say that it's a bear market? This is also another argument that I get. My point is, if you want to define a bear market as a 20% fall, then what is the point of even calling a bear market if it's already fallen 20%? So people like me or Sarvendra here, who's also worked with me for many years and is of course now on his own, doing his own thing, and so am I, after having spent 18 years at Sher Khan myself. Uh, we've sort of spent our time in mastering or looking at how we can do more than just being long only and sleeping investors. We like to know where the risk is, if there are opportunities both on the long short side. So I actually have an approach which is, you can have an 80% investment portfolio, but I also do 20% of a trading, which looks at opportunities both on the long and short side. And the question really is there froth? At the end of the day, we are trying to answer the question, is there a bubble here? Palak, the data you mentioned, I will highlight, and that is probably one of the ways of searching for bubbles, because in the old days you could see it in a different way. It was 1994. I could tell it from things like streets being flooded with IPO forms. That was one way of sensing froth. Or everybody sitting in the first class compartment of Mumbai's local trains reading the Bhav copy. This is how you would see froth in those days. Nowadays you won't see it in that way. They were like, in fact, the newspaper stands would be more than 50% would be financial dailies. Now, if somebody is not seen that time period, he may not be able to identify with that kind of a situation. But those are the things you would look out for. Now today you have technology, so because of technology you don't really have the number of financial dailies like before. The number of IPOs may look small, but the size of IPOs is huge. Oversubscriptions are very, very similar to what we have seen in the past, and this is why we say history does not exactly it rhymes, it doesn't exactly repeat. And we see a lot of the things that I would have seen probably in the 94 mid cap, small cap boom visible today. The participation rates of the crowd also is as much if you have youngsters and teenagers coming into the market. That's very similar to what we saw probably in 92, 94 as well. And yeah, going back to that metric, so how do we really look at market peaks and bottoms? It's not just, I will not just look at, valuation measures have been easy. And to me, valuation measures are also a sign of sentiment. So we basically look for sentiment to tell well whether there is froth or whether there is excess. And when we look at the P ratio, which we also say is the perception of earnings, because after all, the P you're willing to pay for a company is our perception of its future growth and its future earning potential. And that's why you're willing to pay a higher and higher price earnings ratio for that particular company. So it's in the end, it is a measure of sentiment. It is behavioral. It is not purely scientific, though there is science behind it in terms of the discounting of cash flows and interest rates and so on, which is a separate, which is also key in terms of whether you're overvalued, undervalued, and what level of valuation will you give to companies. If interest rates are near zero, then the valuations you might pay may be far, far higher than what you might pay if interest rates are much higher than where they are. So that's another regime shift which is happening behind the surface, which is the reason why valuations would correct. It's not necessary that it is because the earnings and growth potential of the companies does not exist. It has nothing to do with that. It has to do with how you really value a company based on where interest rates are. So that is one reason why valuations would need to correct. The other one is coming back to froth, is there excess? So it always comes back to things like leverage. Leverage earlier could be in the form of margin funding, but it's also in the futures and options market, and you need to measure it in some way. And the way we measured it, Palak, the data that I shared with you is that, say at the 2008 peak, the total futures open interest, which is index plus stock futures, was around 1 lakh crores, around 1 lakh or 1 lakh 10,000 crores. and that was approximately more than 18 times the value of the Nifty. Now, the reason we actually divided by Nifty is because over time stocks go up and therefore the value of the futures also goes up. So if the market is expanding, the value of the underlying futures also will expand to that degree. So that is okay, which is completely normal. I mean, price went up, the value of the future went up. That cannot be said as a addition to open interest. So what we do is we take a ratio of the data to an index and look at it so that we can actually tell whether it's high or low compared to a previous period of excess. And so 18 times looked like a point which was an excess at that point of time. The same level was reached, almost 16 times was reached in 2011. After which, of course, you didn't get the kind of collapse you saw in 2008. But you reached the same level in 2018, which was the top for the Nifty Mid Cap 100 index. And from there, it was consistently down for the next 3 years. The entire mid cap, small cap was sold off. The Nifty, of course, held up till. So, what I was discussing earlier was leverage because most excesses in markets happen because of leverage, not necessarily valuations. And valuations are also there. They do play a part in what we call as Palak. I think my voice is echoing back from your phone. You probably need to mute. Yeah. So leverage is also a reason for excess. Like I'll just give an example. While the 2008 crisis is seen as a significant bear market, okay, it was mostly had to do with the US. In India, even after the entire crash at the end of 2009, GDP growth was still 7%. So we did not really slow down in terms of GDP growth. So in that sense, anybody can argue that the Indian economy was very, very robust, irrespective of the GFC. But the fact is, GFC happened, it was a global crisis and it ended up hitting our shores. And that it did so from a point of excessive leverage can also be seen in hindsight, given that we have seen the NPA banking crisis, we have seen a lot of sectors go through long periods of turmoil and so on. So these are things that we have to be aware of and cognizant of as investors, because excess is exactly where we get caught up, and they do have a direct impact on long-term returns. I mean, for example, we can all go back to seeing, Warren Buffett's, famed portfolio was essentially in FMCG stocks, right? But if you ended up buying all the FMCG stocks at the peak of 2000, uh, even after the Y2K stock bubble stocks were gone, over the next 10 years, you would have not made money in FMCG stocks. Except maybe domestic names, but not the international ones, not the HULs and Britannias of the world. So these are phases also. And can you simply hang on to that? Should you really go for rotation? So it comes back to the main thing. Should you have an active portfolio management process or should you not? Should you pay attention to risk or should you not? Should you say it's okay to have a 40% drawdown, 50% drawdown or not? And so, if you are perceptive of that, and if you think that large drawdowns in your portfolio are an issue, and that most large drawdowns happen from a period of froth, which is best measured by leverage, then today, when we look at the futures open interest at 4,08,000 crores, which is 18 times the level of Nifty, and like I said, the last time that happened was 2018 mid cap peak, and then it only ended with the COVID bottom. 2008 peak, which ended with the GFC 2009 bottom, and 2011 to 2015 maybe, where you also saw a drawdown. So these all phases have happened from times where the open interest in the futures market had reached that kind of level, and that's sort of what we saw. Now that is one metric. Sentiment is one metric. Knowing that there's euphoria. Now you may say, is the SIP inflow a euphoria, or is the SIP inflow a permanent demand support for market, so market can never come down? But then there's the old saying that markets fall on their own weight, and there's a reason these sayings exist. That some things happen. You can't keep pushing something over the edge because it ends up creating a problem at some point of time. We can ignore them till the point that the issue becomes an issue. I think one of the issues that we will continue to face for the next 12 months, and this shifts my gears slightly on the macro side, is rising interest rates and persistent inflation in the US, which is already showing up. So So two major factors, I think: leverage, which is now in the market in this metric, and second, high interest rates, I think, which are going to be likely causes of a more than significant drawdown in markets in the year ahead. At any point of time, again, based on the same thing, sentiment, if sentiment goes from extreme bullish to bearish, we will definitely look back at this and consider that, okay, fine, we should not be too, we were overcautious and we should turn gears. But right now is not the time to do that. Right now, I think the time is to be overcautious, because there is too much leverage and risk of valuations being cut just because of external factors, and that's, I think, being significantly overlooked. And that doesn't mean that stories don't change and that companies don't continue to do well and so on. It's just that markets are markets and they do these things. And I'm not talking of a 700-point drop. If there's a risk in the market, if it doesn't end up happening, fine, we back off and come back after a drop. But I think the risk, if many of these things play out, is for a much bigger decline. So uh, yeah, I'll leave it at that.
Yeah, Rohit. So I wanted to ask you, you are saying there is leverage in the market, and
Yeah,
hence, we need to be careful. That is your one point.
yeah.
I want to ask you, the question here is not that, there will be some correction in the market. Of course, there is going to be a correction in the market whenever there is a sharp rise. The question here is, are we looking at a bubble which is equivalent to 2001 tech bubble, which is equivalent to 2008 housing bubble, or something like that? Are we looking at a fall which happened in 2020 ahead of the COVID, when the COVID lockdown was announced? I mean, nobody in this market will bother about, at these levels, nobody in this market is going to bother about a 15 or a 20% market crash or market correction, rather, I call it that way. The larger question is, are we staring at a bear market for 1 year where you may see a 40% crash in Nifty, 70% crash or 60% crash in small and mid cap stocks, or 80% crash in some of the other stocks? Are we looking at such kind of a market, or are we looking at a plain correction because of the reasons that you say? There is one reason you said there is leverage because the market positions have reached there. One another reason is that interest rates are higher, which of course the Federal Reserve is dangling a carrot of, that they are going to cut the rates, they are going to cut the rates. So this scenario which is there, you call it a potential bear market scenario, or is just a correction, is what most people want to know. If it is a correction, then as Kishore bhai says, every dip here is a buying opportunity.
Then I think, Palak, I'll tell you, the risk really here is of a bear market of significant degree. Okay, the problem is that when we say this publicly, it is used as a hammer that you said this and this is what should have happened, otherwise not. So, for example, I can tell you that the risk is for a 70% drawdown. But if the market falls by 20% and it looks like it's corrected enough and I have to back off on that, I will back off and turn bullish.
Rohit, 1 minute.
But
70% drawdown in Nifty, you are saying?
I'm talking in terms of retracement.
In Nifty, okay. Terms of
Okay.
retracement, got it.
So you have to prepare. You have to prepare for something that can be deep. Okay. And you have to prepare that if it doesn't happen, you can turn. So to give you an example, when we were at 18,600, we thought there was a case for a significant correction. But at 15,200, we were all in bullish because an extreme positioning ended up developing. There was extreme bearishness and it looked like the worst is over globally at that point of time. So these are things that happen and we do. And I can take that stance even in future. But right now, I think the froth is of a level which can cause a 60% retracement of the entire rally since that we've seen since COVID.
Okay. But do you think, I mean, the small and mid, there is over leverage in the market? That is one question. Another question is, do you think there is valuation problem in the market? As we see, the P, if you see the trailing P, which is at
Palak,
19. So
may,
this,
sorry.
Sarvendra, you can go. Sarvendra, you can respond to that. You can respond to that, Sarvendra.
No, I think it's echoing. Am I clear?
Yeah, you're We had Sharad Bhai also. I think if he comes back, we can get him and make him a speaker.
Sarvendra, you can speak. We're waiting to hear.
I think Sarvendra is having some problem, Rohit.
Can you hear me? Can you hear me?
Yes, we can hear you.
Yeah, some glitch I today. So before this topic of leverage goes through, I thought I'll add my 2 cents there. So we have to understand leverage in terms of how I teach my students that what is leverage, and you need to understand. See, by leverage, technicians mean a stretch. Okay, so just imagine a rubber band. Okay, you are stretching that rubber band, rubber band, rubber band, rubber band. You are stretching it to an extreme, right? And after that, it breaks. So we are saying that possibly, and we are all probability analysts. So if you ask me, I would say out of 100, I can never say 100 out of 100. Out of 100, I believe that 95% you have reached that extreme for the rubber band. You do anything more, you break. So you have to understand leverage from, just visualize leverage from that angle. Now also understand that leverage is of two types. The stretch can be in terms of low positions and low. Firstly, what we saw earlier was maybe the positions were lower, but too much. So with high positions and less of margin, right? This time the margins have been kind of controlled. Earlier the margins were less and the positions were huge. So that was one kind of a stretch where on low margins you had huge positions. This time, possibly the margins are there, but the stretch is in the price. This time, the stretch is price, not the positions, maybe. So you also have to understand the stretch can be in the amount of positions, and the stretch can also be in the price. So for me, not that the positions are less, but I would see it as more a stretch of price and the rubber band reaching the extreme, and you put it more, it could break. Yeah. So that was from my side on leverage.
So Sarvendra, you could also take off on what you think of the current scenario. I've probably put out many of my points, so we can take your views.
So I think Kishore Bhai also put up a nice. He had put up his nice viewpoint here. And what I think here, from what we are saying here, is that we are only looking at a possible correction in a bull market, in a maybe long term ongoing bull market. That could also be a way to look at, because India technically, I think the maximum Sensex. Now we have to talk about Sensex because the data for Nifty is only post. So Sensex, because we have data from 1980s. So we have to see that maximum what we have fallen. So in India, we have fallen max 24 months. So 2 years is very less in terms of memory, and people don't remember. But you have to go and check in terms what you lost in terms of price. That nobody looks at. And what I have seen here is that in the last 44 years, that you 12 times the index has lost close to 40%. The index. So from 100 it has gone to 40. So if just assume that you are a mutual fund, right? You are a mutual fund investor and you are told this you are sold this 20-year uh, investment idea and for your retirement, and fine. So you put it there. But had you tried to, even out of those 12-40% corrections, had you just by some means, and we have been timing all that. So even if you are able to save 10% every time, which means you sold 100, you bought 90, you sold 100, you bought 90, you would have added 100 out of those 100 units that you initially had. You would have added another 111. So your portfolio would have gone to double, and whatever the prices are right now, that also you are getting. Plus your portfolio has also gone double. The power of trading, if you do it right. I'm saying every 4 years this happens in the market. So it's not that I'm saying, it's for everybody to see that Sensex falls every 4 years. And 1986, 1990, 94, 2000, 2004, 8, 10, 14, 18 and 20 were small falls, but there were two falls in a year. And then 24, we are saying that there's a possibility. And that is where we have come up and trying to put across a point that something which is repeated so what do you call, so nicely and so copybook and so on the clock. I think you will be an ostrich to stop looking at that and looking the other way, right? So this year definitely, if not now, maybe 3 months down the line, but this year possibly is going to be a finally the close should be a red close. That's my 90-95% confidence right now. And for 5% that we go wrong, we always have a stop loss. So nothing to get emotional about, and you have to be both sides of the market.
Yeah, Kishore bhai?
See, corrections are always welcome. And what other gentlemen are saying, I don't agree with them for simple reason. Lot of things which are fundamental has not been factored in. First rule of the bull market, thumb rule I would say, bull market is buy dips. If you try to play on both sides, you will get slaps. Always you will get a slaps. But bull markets are meant to only buy dips and make money, not sell and buy and sell. That is number one. Number two, in this entire scenario, everybody is ignoring government. Who is running the show here? Why I'm saying this? The Reserve Bank of India and Finance Minister is on record saying our GDP will be 7%, and that is the fastest growing economy in the world. Now, I would personally feel that it could be 7.3% also. Apart from that, they have brought down our fiscal deficit from 5.8% to 5.1%, which is not done by any other country in the world. And to put some other facts, I would feel that it could be 4.8% also, because they have already announced to sell the telecom spectrum and coal mines bidding, which might, I don't know what amount they will add up, but they can add up 5-6 lakh crores easily. And if they add up that much amount, over and above that estimated tax revenues, the fiscal deficit scenario will change, market borrowing will go down, and corporate earning is not at all getting affected. In fact, the capex has just started. And when capex starts, the earning growth also, visibility of earning also improves further. Instead of talking about private companies doing capex, I would say that even government is doing a lot of capex. Last year they did 10 lakh crores capital spending, and this year they are doing 11.11 lakh crores capex. And for every 1 rupee spent, we expect a return of 5 to 6 rupees to our gross earning. Now, if you look at from even 1991 till 2017, there was no capex. There was no confidence. People started having confidence on the government, and then COVID happened. So real capex started only in 2022. Every company started expanding now. Now, take the example of our steel industry. Our capacity is 150 million tons, and they are expanding to 300 million tons in just next 5 years. When you are talking about 100% rise in capacities, the numbers will improve, top line as well, bottom line also. Now that means the growth is continuing. Now if you ignore this factor and try to be a bearish, most welcome. But I am bullish with 19 price earning ratio. I don't think so market can correct a big. Yes, of course, market will go some sideways post-election, but after a smart rally. This is every time has happened. In 2014, when Narendra Modi came to power, Nifty ran from 6,000 to 9,000, almost 50%, and then corrected to 7,500. And it was sideways, and then they crossed 9,000 second time. So to give examples, there are hundreds of examples I can also quote. If we are talking about 40% correction, we are talking about 1991 when we pledged our gold in 1991, where our PE was 11.6. When we were nothing, that time also we traded at 11.6 price earning ratio. And today you are saying that no, 19 PE is not acceptable. Then can't help it. Average price earning ratio, again, I'm saying it is 25. So if we take the difference of 19 and 25, there is enough scope for market to go up. But post-election, today, March, every March, there is some correction. And before correction, every time we hear of big bubbles, big corrections, market busting out, all these things. At 15,400, CLSA issued a report saying the all is over, market is heading for 14,500. That day, Nifty turned positive and went up like anything and crossed 17,500. So drawing call that no, it will correct is next to impossible. Market is not in control of one person. Market is not controlling our FIs. Right now, DIs are getting 18,000 crores a month in SIP, and they are drawing the cards. So market is definitely in a good health. On any parameters of valuation, whether it is market capitalization to GDP or price earning ratio, we are at very comfortable level. Now, one issue which was discussed is leverage. See, leverage is there because of the expansion in size. If you look at the measures taken by SEBI, so all systematic risk have been eliminated. There is no excess margin allowed. There is no excess funding is allowed. There is no excess trading is allowed. There are so many sectors created where positions building is not allowed. So what is left is derivative. So derivative is only a function of short and long. If there are enough short positions, market will go up. And if there are enough long positions, market will correct. And that will be a short-lived scenario. Just before 3 state elections, FIs were long almost 87,000 contracts. And they had to change their position and Nifty run away by 1,500 points. So it's very difficult call saying that market will correct and this leverage is there. This is all game size. And in fact, if you look at the open interest, in 2010 also, we were seeing 1,10,000 crores. Today also, it is 1,10,000 crores only, Nifty open interest. So that way, you don't see market has expanded too big. And secondly, corrections are always with percentage to the Sensex or Nifty. When Nifty was 10,000, 100-point correction was also painful because it was 1%. So today at 75,750 correction is also a 1-point correction only. That factor cannot be ignored. So percentage wise, the correction will remain same. We have to accept that. So if market corrects one day 750, tomorrow it might go up to again 700 points. Once expiry is done tomorrow, nobody will talk about correction. On 10th March, books will close for new fresh funding. So there won't be new positions for operators and HNIs from 10th March to 25th March. So that will be a lackluster period. But post the 31st March, again, positions will start. And with elections clearly turning in favor of BJP, there could be a good amount of rally before market gives up. And that happens after every election. This is my simple view.
Rohit.
Yeah.
Rohit, I tend to agree with Kishore Bhai for the plain reason that, for the market to correct in the manner that you are saying, there has to be a real squeeze on cash, which is not the case currently. Like Kishore Bhai says, there is 18.
Palak, I want to add one more thing. Whenever the corrections happen in the past, there were some international reasons, not domestic reasons. And today markets are going up irrespective of all bad news. Whether you take Ukraine war, whether you take this war, whether you take inflation, whether you take deflation, whatever you call, all there are bad news. There are not good news. Yet market is going up. So good news will follow. So market will soften only when the good news come into place, like rate cut. If Fed starts cutting rate, then market will run first and then they will see some sort of profit booking, not before that.
Yeah, so clearly, Rohit, I see the point that there is too much of fear. When market goes up 10%, 15%, when stocks rise fast, there is too much of fear of a crash. And that fear of a crash is keeping the market from crashing big time, because every time the market goes up, there is correction. Like if you take 1.5 month, the month of January and also February, you see, markets have already corrected by at least 3 4 times. Nifty has gone down 500 points and again come back, and stocks is the same. There are many stocks which have gone down 15 20% and again they are coming back because of this, as Kishore bhai clearly pointed out, because it is because of the inflows that are coming. 18,000 crore every month in the mutual fund industry. That is one reason. Then there are insurance companies, then there are other players, corporate bodies. So that cash is, there is too much of cash in the system. The PE is extremely low. The potential for earnings upgrade still remains in the market. There is no credit event that we see in India, as well as around the world. Now inflation was a major problem for the US, and that is the reason they hiked their interest rates. But if you see, the government spending is also very high, and that is the reason you understand that inflation remained high. If they curb government spending, inflation will come down. There are all the reasons to cut interest rates by Federal Reserve, and they are dangling that carrot to the market. So where is that kind of a credit reason for the market to fall, cash squeeze for the markets to fall? For example, I'll tell you, Indian government has announced that they'll be spending 22 lakh crore on modernizing the railways and the related infrastructure. Now that kind of, and that is only one segment of the economy. There are other such segments in the economy. The kind of Robin Hood act that the government is doing by spending on social schemes, and these days the money goes directly into the bank accounts of people. So it is, in a way, everything is coming back in the economy. So there is no cash squeeze, if you say. So in that scenario, why do you believe that, I'm not getting a key reason. I mean, I'm not getting a very strong reason from your reasoning, from your analysis as to why the market should fall. Only thing comes out is there is too much leverage in the market. Fine, agreed. If there is leverage, it has to correct and come back. Earnings potential is still there. If the PSU stocks have rallied, and they have rallied sharply, I agree, but they did not rally for many, many years. 10, 15 years they did not rally. And after 10, 15 years, if they are doubling or tripling, I don't think it calls for a massive cause of correction or a market crash as we are debating here. Rohit?
Yeah, there are many different points. I probably use the leverage focus because that is the easy one to argue. Because most bear markets are caused by excessive leverage. That is just the easy fact. The other factors we always, in hindsight, pick on. Oh, this was also too much. That was also too much. But it's usually excess leverage. That's like the most historical proven data point for bear markets. It's not necessarily fundamentals. So all fundamentals are good, but excess leverage comes in and bang, it creates a bear market. That doesn't necessarily mean that the fundamentals change, which is what 2008 also was. I highlighted that in the beginning. End of 2008, start of 2009, GDP growth 7%. You still got a GFC. Now you can say, okay, that's because of external forces. India never had a bear market, and which is why I started references with 1994. Now, there are smaller cycles, there are bigger cycles, there are higher time frame cycles when we study. The reason I go all the way back to 1994 is that was a complete cycle that started from the 70s, 80s, reforms, and the first round of the phase where everybody got involved in markets and you got a lot of investment coming in. Now we start believing today that because you have 18,000 crores of SIP coming in, therefore markets can never go down. But that was the same case in 1992-94. There was too much money coming in, markets could never go down, but they still did. And so there was a domestic reason why it happened, and then you have to go back and think why it happened. And it was again inflation and interest rates and all had gone up too much, and that automatically forced the slowdown. But even high interest rates were not really slowing it down at that point of time. You had interest rates which were almost at 15% being offered by banks, okay, at that point of time, which is 1995, 1996. Now you have to have a memory of these times to be able to relate with what really happened. So why did UTI get shut down? Because excessive money went into them. Why did they buy only mid and small cap stocks, which everybody is doing today? Now we can say SEBI's done a great job of putting curbs on everything. So that leaves us only with FNO market. What also happens is people are borrowing from banks, a number that we will not be able to know till we actually dig deep into the numbers, ki how much of borrowing has happened outside the system, and there's actually leverage at an investor level, which may not be there directly as margin funding. There were recent articles also about bank deposits actually taking a hit because of money going into the stock market. So there are various angles in which excesses happen. They don't show up in the front of it till things have really turned. And at the time excess is happening, there are a lot of bad actors also. So for example, if there are fly by night operations happening, or there are IPOs of companies that are complete junk going on, you will not know till you have a bear market that which were the junk, which were the ones that completely disappeared from the face of earth, and which are the ones that stayed around. So these are things we only come to know later on. We don't come to know at that point. At that point, we can only be able to identify whether we've reached a point of froth or not, and that is clearly visible through the very participation itself is froth. The kind of money that is flowing in. Say, for example, one ruling which was there, okay, the mutual funds can only invest in this basket of 100 or so mid cap stocks, right? There's a basket created by SEBI. So now every fund that is getting mid cap flows and so much money is coming in has to keep buying the same stocks. If you keep buying the same stocks, you create excessive valuations in a particular segment. Now, you want to go and check the segment valuations, then you do that. Now, fortunately, we have a platform. It's called Strike. Everybody can check it out on web.strike.money. And what we have added there is valuation charts. And one of the reasons is because I want to democratize data for the public. Why should only 4 analysts know कि valuation कम है कि ज़्यादा है? मैं क्यों बताऊं? आप खुद जाके देखो. 2 standard deviations है पे 1 standard deviation है कि 0 है. So you go and check all these stocks and see their valuations on a 10-year basis. We have the entire data for 10 years, and I will eventually try and push it to 20 years so that you can even see the peak of 2008. And when are you at 2 standard deviations of your 10-year valuation range? And if you are at over 2 standard deviations, then why are you seeing that valuations are less? Because this is the historical range of the company's valuation. So you start thinking, when you start thinking on those lines, then you start seeing things very, very differently than you're seeing it right now. I mean, for example, this is a very big company, and I'm not giving a recommendation. We are not investment advisors. I have to mention it. But if you just look at the historical valuation chart of Reliance on a P ratio, it has the highest valuation in history. So that is just the simplest answer I can give you. Is it too much or not? Anybody can decide on their own. But this is what markets do, and they do that because there is excessive liquidity in cash, which you are speaking of. Now we can say, oh, but who's going to remove the cash? Yeah, nobody, unless there is excessive or persistent inflation. Now in India, we may not think 5%, 6% is persistent inflation, but in the US right now at 3%, it's likely to go back. What if it goes back to 4 and 5? No, that's not possible because the Fed says so. But you just said, Palak, that the government can cut back its spending and everything will be okay. You just try doing that. The only reason you had growth in the last quarter of 2023 was because the US had the highest delta of spending ever in the history of government spending. Okay, so that kind of spending that they did, which is pushing up their deficit by $1 trillion every 3 months, is the kind of spending they had to do just to keep this economy appearing like it's continuing to grow. But does that mean that the S&P 500 earnings is growing at 20%? The answer is no. It is barely growing in single digits. So the stock market is holding up on a couple of stocks. That is the fact. So let's know the facts and then put everything in perspective. But then of course that is the US, so let's not even go there. So they have their problems. Their problems can hurt us. Sure. So I am saying that their problems can hurt us with higher interest rates. That is my view. Rates will probably go higher from here, and they've already started inching up. We can ignore that, or we can pay attention to it as a macro factor that will eventually bring down valuations irrespective of growth, because you can pay 50 times for something if interest rates are 5%, but you can't pay 50 times for something if interest rates are 10%. So it just doesn't work that way. And that's sort of a process that started in 22-23. Remember that when the US correction started in 22-23, it was called a valuation correction, and people started buying value stocks, which is why the interest to PSUs came. And I have not been a bear on PSUs. You also know that, Palak. You have published my article in Business World, which was giving a 50% and 60% higher target on PSUs in the month of September. But then we have already seen stocks move up so fast that somewhere, the readings are very, very high. Are there the top end for PSU valuations? The answer is no. We are not at the top end on a 10-year scale. So definitely PSU stocks can't be called overvalued, but there are other sectors that are. And but then that also needs to cool off at some point of time. But why did money go there? Money went there because other things were excessively valued. So basically the markets were chasing value because there was a valuation correction happening in growth. And that valuation correction in growth, while we may think it is complete, it looks like possibly not, because rates remain elevated. And that's the issue from the global side. So that is how it's affecting India. Will Indian growth continue? Well, India was spending a lot last year. That is also fact. So last year also post budget 30% capex added. I was also bullish on capital goods sector last year. But the question is, can they keep spending that much? And so, even in this budget this year, we've shown that we had to step back. Fighting fiscal deficit is the oldest story. For 20 years or ever since I was born, the story has been fiscal deficit कम करना है. तो हम लोग 30 साल से कर ही रहे हैं. So that is not new. That doesn't mean debt to GDP doesn't go up. It simply means that it goes up at a lower and lower rate. But when you cross 100% debt to GDP, then you have reached a crushing point, right? And the whole world is already beyond that. We barely got above it, and now we are pulling back below it because we are, of course, able to grow better on every rupee spent than many other places around the world. So, of course, we have that advantage. But we did reach a, because of the post-COVID spending, the entire savings of 20 years that we did, because the debt to GDP ratio was 95% for public debt. I'm not saying total. Government debt was around 95% in the Vajpayee regime, because they did spend a lot to get the economy moving. And then over years of being tight, which was the right thing to do, you can say in hindsight, it came down to almost 67% or 62% by I think 2019. So it was a huge achievement. But COVID made us spend again, and the number went back to over 90%. Okay, so fine, we had to do that at that point of time. But we are not at a point where we can just keep expanding and spending at the government side without being aware of the idea that we've already pushed up our budget a lot, and the private sector needs to seriously step in. And if they don't, then that is another issue. So these are all multiple factors from various angles. But the most important and easy ones for me to point out for the correction are interest rates and leverage. Those are easy to understand. The others are more complex. Like I said, I relate this with the 94 cycle, where public starts participating at scale, money goes into mutual funds at scale. At those times, also, those amounts were large compared to the money available in the economy, the size of the money in the economy. As a percentage of savings, also, it was in double digits. I know the CMI number, I've seen it back then. Now, many of those data points are no more published or available, or they've changed, but we have seen it gone into single digits over time. So it had significantly dropped. So when you get such large participation from the crowds, it somewhere leads to excess, and then that excess has to at some point get corrected. Now, the easiest thing, the biggest mistake we can make, and I can make, is being early in calling it excess. Surely, I accept that. But we are trying to measure it in different ways. And one of the ways, which was an easy metric, which I have because it's on my platform, was the ratio of open interest to index, and that is why I've used that to pinpoint that the leverage is already at 2008 levels or 2018 levels, both of which led to a significant collapse in mid caps and the indices as well.
Okay. Rohit, do you want to take questions?
Yeah, I am okay with
Palak,
that.
on
Yeah,
the leverage,
Sarvendra.
I can
Yeah,
just as
Sarvendra.
an
Please come in.
anecdote, I'll add on this leverage part and leave the answer to the audience. So there are more than 50 stocks in BSE 500. Okay, which were the last, and from the bottom of 1919. Okay, in last 25 years, there are there are 1000x, 1000 times from whatever price they were then. And if this is not a stretch, and if this is not a leverage, I don't know what it is then. So I leave it to people to judge, but to make a point that sometimes the leverage is in the price. It need not always be position, always the margin setup, but sometimes the price itself goes out of whack in the amount of time that you are looking at. Okay, so that would come back and hurt. Anything that goes vertical comes back and does a time wise correction. So we are also saying that within the large longer term bull market, possibly in India, you could get one comma. We are not saying that this is the full stop. We are saying there is a comma, and that this comma will hurt.
But one of the, Rohit, Rohit and Sarvendra both, one of the biggest elements of any stock market rally or any stock market crash is the price to earnings ratio. Okay. And we have seen that, price to earning ratio went berserk in 2008 and all 2001 and all the previous crash and bear markets that we have seen. But this time, that one single metric which is there is showing signs of market continuing its rally. So on that specific thing, Rohit and Sarvendra both, I would need your inputs. That why price to earnings ratio is indicating that companies still have a great potential of earnings growth from here. if you go by trailing PE of 19 for Nifty. So, that is a key reason, uh, where, key metric where everybody, where those who are bullish on the market still feel that, there is a rally left. Of course, there is froth in terms of positions, as Rohit is pointing out, leverage. But again, I say that, this could be a reason or a catalyst for correction, not a crash as we saw in 2008, 2001, and 2020,
So
before
chalo,
COVID.
let me also give you
may I answer this?
Palak my okay. Sarvendra, go on.
Yeah.
Yeah, this is for the technicians here on the group, possibly those who watch and do technical analysis. See, P ratios is also an indicator, right? And it goes from whatever 10 to 29, 30, 42, wherever it went. So P ratio is also an indicator, and people who use indicators like RSI, MACD would appreciate this fact that sometimes in a bull market, sometimes when the prices are going up, the indicator refuses to go up. That is called a negative divergence. If the indicator is not able to put a new high along with the price, we call it negative divergence. And this, possibly with this discussion, it is also giving me that eureka moment that since so much is being talked about the PE ratio, I think this is a perfect negative divergence going forward. So this negative divergence itself will be the reason possibly to get you a good drawdown. And as I rightly pointed, this is a comma that we are calling a decent correction, a comma, and we are not calling a full stop on the Indian story. So this spaces is definitely not about that. Trust me.
Bang on, Sarvendra, bang on. I was just going to mention this divergence thing. I think people have not even thought of that there can be a divergence on a PE chart. I was just showing it in we were trying to make a video for, for the people on our platform, and I was actually did it, and someone came back to me saying, "Arey, this is not, this is not like what we were teaching people earlier." I said, "Boss, look at the charts now." And why does this happen? So I'll tell you the differences between growth and cyclical stocks. Cyclical stocks tend to have a lower P ratio at the top and a higher P ratio at the bottom, and everybody should know why. It's because the highest, growth numbers come at the top, and the P ratios drop. So you actually, when you see it on a chart, and I was seeing the Hindalco chart, 10-year chart, and I was seeing there was a P divergence. So for example, prices were going up and the P ratio was going down, and then the stock topped out and started to fall. So these kind of things actually happen, but because when you don't have charts in front of you, you can't really imagine that something like that is also possible. And another thing which has happened with valuations, we are all looking today at what is a very very nicely hashed valuation chart, because the great exchanges in India don't give you historically adjusted charts of valuation. It's very nice to say we should move from historical to from what do you say, standalone to consolidated. Yes, from a fundamental standpoint of view, that's very very right. But why don't you also give me 20 years of historical data which is adjusted historically, right? You're leaving that work for me to do. And in a sense, and they did that with the price to book ratio also starting from September of this year. So when they are doing that, automatically the ratio is dropping by 20%. We are justifying today ki historical P as per Nifty reported P is 22 times. But if you actually went by historical data, that would not be an overbought or oversold condition, which means now if you compare all the previous peaks of the market with adjusted charts, even today's P ratio may be high, but because you don't have an adjusted chart showing that, we are sort of justifying that this is a low P ratio. So I'll just put that in context, and which is why I said if you go and look at individual stock P ratios on a 2 standard deviation scale, then you will actually see that many of them are at 2 standard deviations and they are expensive.
Rohit, we should open the. Can we open the floor for question? Should we open it?
Palak, can
हाँ
I
हाँ
put one more?
किशोर भाई बोलिए बोलिए. Tell me.
The common mistake we generally do, I think you put up your speaker. The common mistake we generally do is to look at the equity and decide whether we are bear market or bull market. A bull market or bear market is decided by commodities. The last bear market started in India was in 19 till 2003. 2003 we closed the last bear market and the bull market started, and it is still on. The real bull market has to be judged from commodity angle. So long as there is a demand in commodities and capacity expansions are happening, we are in a bull market. The moment bear market starts, capacities will start narrowing or plants will start getting shut. That will be the stage of a bear market. So corrections cannot be labeled as bear market. Bear market generally has to be for 20 years and bull market has to be for 20 or 22 years. So there, with all these intermittent corrections, 2008 was a correction, 2010 was a correction, 2014 was a correction. All these were corrections, not a bear market. Bull market is continued, and the mother of bull market is yet to start. So I feel personally that there is a lot of upside. No doubt there might be corrections, which we have to factor in and which we have to carry on.
So Rohit, I think we should open the floor for questions. Even I have several questions, I
Yeah,
think, but that will
sure.
not end. One question, Rohit, though, was we had a very bad debt burden on the corporates in India for the past few years. I mean, since 2008, between 2008 and 18, we had a very extremely bad debt scenario for corporates in India, where everybody had borrowed heavily. But that froth is also out of the system. So I think that is again sign of uh, where we are, where we see that there's no problem with that. Anyways, we'll open the floor for questions, Rohit. If you see anybody you think you can give them right to talk or ask a question. Rohit,
Yeah, I'm doing that.
any of the listeners want to
Yeah,
ask a good question? Yeah.
VIP 53, I think you're added as a speaker. You can ask your question to anyone. VIP 53,
VIP 53 is there. Mahesh is there. Both can ask.
Mahesh. Okay, Mahesh has dropped off.
I think Twitter has got serious issues today.
Yeah, I don't know. I mean,
Yeah. Amit, if you have joined, you can speak. Yeah, I'm adding speakers, but
yeah, a lot of people are not able to talk, I think. You're right, Sarvendra. Actually, Twitter has had a lot of
Lata?
problems. Yeah, Lata is there.
Yeah.
Yeah,
Yeah, we can hear you.
Rohit, a question, because I have a lot of respect for your analysis. You were the first one to actually spot the change when the market was going down and got a lot of flack from the 12,000 cartel, but you stood your ground. I wanted to ask you at this point whether you are, of course, seeing the dark clouds in the horizon. But are you seeing that within the market itself, there are a few sectors which are going to outperform the fall, which are going to stand their ground? If you can specify, if you have any such idea. Thanks.
I think so. This is a slightly tough one because when you start thinking bear market, most bear markets have meant that pretty much everything dips. But if something has to outperform, I can think of pharma, or something has to do well with dips in between. Probably that, because it's one of the late sectors that has picked up. It didn't do so well after the initial COVID rally in India, and it actually went through a 2 year bear market when stocks were doing well, and it's actually picked up only this year again. So that probably stands out as something I would look at in dips, if at all I have to get invested. Would be in pharma.
Nothing else. Is that the only sector you see? What about IT or any of the other laggards which have, in the last 1 year?
No, IT is going through its own troubles. Right, they are not able to make it back even to the 22 highs, which sort of tells you that they are not out of the woods. And since it is a globally linked industry, something happens globally, they are hit first. So that is why IT is not something I would want to take a risk with.
Okay, that's great. Thanks so much. Thank you.
Yeah, is there anyone else?
Yeah, I'm trying to add some more.
Can I ask a question while we're waiting?
Yeah, sure. Yeah, sure.
Yeah, Rohit, again, I'm asking you, what about the domestic sectors like, the hotel industry, the aviation industry, which are going through a boom? Are you expecting that in this fall, these sectors which are doing very well will also fall along with it, or will they, keep rising?
Yeah, so this is what key. When you see, when you if you do get a bear market stimulated by the factors that I'm saying, which is interest rates and leverage, then it sort of ends up affecting everything, whether for good reasons or bad reasons. It just affects everything. So they have run up a lot. They can get a decent correction. They may end up being available at better values. So I would expect everything that has done well to pull back.
So
And
they
in
won't be
the
able to swim against the tide or something, according to
it's
you.
no it usually doesn't happen that way.
Okay, okay. All right.
In that case, Rohit, what is your view on Adani stocks? You
I
see a
I think
sharp pullback in them too.
let me not make stock specific comments.
No, I am talking about, see, because
I
it's
know
not a
it's a
stock
group, but
specific comment. I am
yeah.
talking about the corporate house, or because I know it's a loaded
So
question,
let
but
me okay, let me answer the question on Adani. You need to mute again. Let me answer it in a different way. And this is an interesting way to look at it from a technician's perspective. The market peaked in 21, fell, and then it took off from 15 to 100. Today we are at 22, whatever. We are at an all time high. Adani stocks have managed to move up, but on average, none of them, except maybe one or so, or maybe none, have gone back to an all time high. Okay. Adani Enterprises is still within 66%, exactly at 66% retracement of the entire fall that it did previously. So in that sense, they would still look like they are in a bear market. So the only thing which happened, I think, Palak, between the spaces that you did with me and we did on Adani Group, when we thought, oh, that was an overreaction. The truth is, from their prices came back up. But now that they have risen so much, they are not gone back to new highs. Is a negative divergence, again, to use a technical word. It is a negative divergence where markets make a new high and the group doesn't make a new high. To me, that is concerning. There is still an incomplete case on the sector, on the corporate, because the international operations and investigation is still going on. So I would still wait for that. I don't know what other risk may be there. It all looks okay right now, but I'm saying there's a technical divergence.
okay. There is one more question that comes to my mind. At these times, regulators, SEBI, saying something like, there is froth in small and mid cap stocks, then Association of Mutual Funds, which is kind of an SRO, writing to the mutual funds to protect investors from the risk of rise in small and mid cap stocks. I think this is regulatory overreach, and that is the key reason. That is one of the key reasons that market crashed today, is because SEBI and AMFI came out with such reasoning. Do you think any of you, Rohit, Kishore Bhai, or Sarvendra, I mean, does SEBI or mutual fund industry, do they have anything to say in uh, anything on this? I mean, on valuations, or I mean, there has to be
I
healthy
see.
speculation in the market, right? And that is market. Healthy speculation is market.
Palak, last month before expiry, similar statements had come with regard to large cap index and market correct and bounce back. So this is a part and parcel of market. So one should not really bother about it. Mutual fund industry, can you just mute it? The mutual fund industry, when I spoke to them today, they were least bothered. They said that we have been making all disclosures what is required. So there is nothing new. They found it out. So I think there is no need to react on this. Before expiry, this kind of correction is always, it has been happening and it will always happen also. And without 1% correction, rollover also is not possible. Tomorrow, if we see Sensex 700 points up again, then nobody will talk about today's correction. Now, one thing you need to understand that few years back, we were only 4 crore investors, which has now reached 16 crore as per BSC's website, official website data. And as per the insiders, they say that this number will be around 25 to 30 crores in next 2 years. So that means SIP will rise from 18,000 crore to 25-30,000 crore. And that is a good money chasing market. So whosoever says that liquidity chasing, it will evaporate, it was like past, it is not correct. The money is real, money is coming. And SEBI is now devising even new scheme, even 250 rupees scheme is also coming. So Rickshawala and Panwala, everybody is going to contribute into SIP. So more money will come and more market will become more healthy. So I don't think so any issue is there. We have to go by our own conviction. Price earning ratio has already sustained. And whenever big correction has come, it has come from 27.8 price earning ratio. If you look at last 20 years data. So 27.8 is too long. We'll see that time if correction comes. And if it corrects, if it comes, it is always welcome.
Yeah, I think
Kanan?
Rohit, we can
Kishore
take
bhai,
some questions.
just a question for you.
Yeah.
Rohit
Yeah.
was saying that this data has to be adjusted. So when you're talking about this P data, is your data adjusted for the new changes of the last 20 years? Because I was also not able to find that data.
You can find out data, any data score. It is adjusted data only. See, what is important is 33 years average. That cannot be manipulated. You take 10 years average, you take 20 years average, you take 23 years average. The data is there everywhere.
No, data is there. Since the calculations have changed, so the data might not be
That will
comparable with
keep on changing. Even SEBI, that will keep on changing. If stock is not performing, exchange will remove some stock and move it some other stock. Ultimately, we are giving weightage to 30 stocks or 50 stocks.
No. What Rohit was saying that the metrics of calculating the P itself has changed. We are not talking about stocks being changed. That we also understand that the index keeps on changing, but the entire calculation of the P has also changed over time.
How?
That
No,
I
they have
think
changed it
Rohit
from
will be the better person
standalone
to
to consolidated, na?
A consolidated only I'm talking. I'm not talking standalone. Now standalone is not there,
Rohit, can I ask you a
consolidated
question?
only.
This is Kanan here.
No, that is what I asked. Consolidated, you have 20 years, last 20 years, sir?
Yes, sir. Yes.
Okay, I love to see that. I'll DM you. We'll share.
Yeah, sure.
Yeah, Rohit, we can take few more
Yeah,
questions.
Kanan, you have a question.
Yeah. Rohit, I'm not sure whether you have kind of covered this earlier. I just joined. So 2024 being an election year, right? Not only in India, but I heard somewhere that 50% of the world population will be voting, right? And there is a general belief that market never falls during an election year, right? So that is one part of my question. The other part is where will the trigger come from, right? So I completely agree with all your points, right? So I'm figuring out where is the catalyst, right? What will be the straw that will break the camel's back, right? So will it be from the global scenario or from the Indian economic scenario? Because I read, IAM placements is tough, the tier 2 bids Bilani placements is tough, it's not happening, right? So there is a cash shortage that the businessmen keep talking about on the ground.
Your voice did break in between, Kanan, so I didn't get the last part of your question.
No, the first one is on the election year,
Yeah,
right? The
that I
second
got.
one is
That I got.
yeah. Okay. The second one is basically where will be the catalyst or the trigger will come from? Is it the domestic factors or the external ones?
For a correction.
Yeah, for the correction, yes.
I think in domestic, I'm mentioning over leverage. In external factors, I'm mentioning interest rate. So those are the two factors. And as far as elections are concerned, each election is different. We believe that there are no bearish trends in elections. We have seen 2004 where Indian elections markets fell, 2008 US elections markets fell. So this belief that markets can never fall in an election year, now we may say, oh, those are outliers, but then that's just a counter argument. In the 90s, of course, there were many ups and downs depending on whether you got coalitions or what you ended up getting, in the end. And 2019 wasn't exactly a great election rally compared to 2014. In fact, after the elections, markets went down all the way till September. So each case is different. This time around, I think there's so much euphoria around election. Everybody is sure who's going to win. It's already priced in, is how I would think about it. So there's nothing left to discount.
Okay.
Siddharth?
Hi, Raghavendra here. Can I go ahead with my question?
Yeah, go ahead.
Hello, my question is for Rohit ji. This downturn that we are trying to predict, what could be the potential duration of the downturn and any high-level targets for the most widely tracked indexes like the Nifty or the Nifty 500 that you have in your mind? And the second part of the question is, we have already seen some sectors like the staples, where in last 3 years we have seen stock prices mostly staying neutral, not having done much. Also, all those buy at any price type of stocks having not done much. So, are those stocks going to stand strong in this downturn? What is your view?
Yeah, Rohit.
Hello, sorry. So, see, your question is like this, that which relative sector will do better? Now, on a relative basis, see what happens when we say this is a bubble, and if it is a bubble that gets pricked, typically after bubbles, everything goes down. Very rarely, the only thing you figure out later on after it has happened is what has gone down less and what is outperforming tells you what will do well in the next cycle. For example, HDFC Bank barely fell throughout the 2000 Y2K bubble. It was the only stock that didn't fall, and sort of HDFC Bank can then be seen as the outperformer of that period. But that was a single stock, and so it may happen, but we cannot say that in advance that there will be something which will completely not be affected. It could end up being a single stock or something here and there, but that we'll at that point of time we'll look at it more as a positive thing for investing there. But typically during a bear market, almost 99% of things come off in different degrees. Now, when I say, okay, what could be the downside level? See, we all want to have a target and then we want to hold someone for that target. What I will tell you is that this kind of ratios, the leverage that we've talked of, have historically caused big drawdowns. Big drawdowns meaning mid caps have collapsed 50 to 60 to 70% in terms of individual price. Whether the Nifty falls by that much or not, that is what we have seen, because even between 2018 and 2020, the Nifty was down 30%, but mid and small caps were down a lot more. So the drawdown in the broad market was far sharper than in the Nifty itself. So that kind of variation also can happen. The point is whether you are prepared, and that preparedness can come by different degrees of cash in your portfolio, right? Because some people say, okay, I want to deal with only a 30% drawdown. Fine. So if you want to deal with a 30% drawdown and not more than that, but if the market falls more, if you create 30% cash in your portfolio, your drawdown will not be more than that, even if the market falls by 50%. So there are different ways you can manage it. without really getting too worried about it, depending on what is your risk profile and what is your appetite and how you want to deal with it. So that is a question. But what I would say is broadly, we I would, at this point of time, I would prepare for my worst case scenario. Like I said, a 61% potential retracement of the entire post COVID rally. The entire COVID rally from 2020 to 2024, this 4 year rally needs to get corrected to some degree before you can resume the ongoing bull market, and that would be painful.
All right. Thank you for giving me the opportunity.
Yeah, Anuj Dikshit.
Yeah, hi Rohit. Hi Palak. Uh, Actually, I just wanted to have your view that do you see any kind of similarity in charts, especially on the weekly and monthly charts between 2008 and 2024? I know because I do look at charts, so even I have the similar view that okay, axis is on one side and there will be a so to call a deeper correction in market. But I do look at the similarity between 2008 charts on the weekly and monthly and similarity in 2024, which is happening for last 11, 12 weeks. Looks like a distribution kind of pattern. Do you see that pattern is happening? And second thing which I would like to know that if this correction happens, uh, what will be the starting point for you to know that okay, this is coming? I know at this point of time we are just saying that it should happen, but then the confirmation will be needed on the weekly closing or daily closing basis. So is there any level that you are watching out that okay, below that level there will be a more confirmation for this bearish view?
So, Anuj, it's not one level. There are multiple levels on daily, weekly, monthly timeframes.
Yeah.
And each of them we deal with on an ongoing basis. So it's not like, okay, today this, and then only I know 100%. No, I start with the view 100% and I keep looking for confirmations. So for me, it is a process. It's not a die hard this or else kind of thing, but it is a process. For example, today in the very short term, we would look at the 20-day average, which is like around 21,950. You close below that, then we start thinking about the next. Then we start going from daily levels to weekly levels. Okay, where's the weekly, and then where's the monthly? And then we look at our own momentum indicator, which will give us sell signals. Today, it's given us a sell signal on the daily chart. Will it also? It's already in sell mode in the weekly charts for Nifty, not yet for the monthly. And we look at that, and then we look at for the same on the 500, because the 500 has not given a weekly sell. So these are multiple different confirmations. They keep coming in, and we'll keep watching for them. And that's what I try to cover.
Okay, and what about the similarity which I asked that do you see any weekly chart similarity between 2008 and 2024 at the top? Because in 2008 it was a between November and January, the
Yes.
kind of distribution pattern which was happening in a ending diagonal, and
Yes.
similar at this point of time it looks like. So
Yes.
do you see that similarity?
So with 2008, that is the similarity, what you just mentioned, that they were different even as the Nifty was forming an ending diagonal, which it is also forming now. Different sectors were still overshooting, including oil marketing companies and PSUs, and they all kept rotating, making those last run rallies for the last 10%, 20% moves happening in individual stocks, but Nifty was forming an ED. Same thing has happened in the last 2-3 months here also. 2018 was slightly different in that nature. It didn't have the same pattern.
Okay, okay. Thank you. Thanks.
I think last question we'll take Siddharth.
Yeah, hi Rohit.
Yeah.
The question is that which cycle of past 30 years would you compare the current cycle with? I mean, most similar to. And my second question would be that the correction which you are expecting in India, so how much of it will get correlated to outside India, like in the US? And is this the big one which many on Twitter and other platforms also have been waiting for? Like 70-80% kind of bear market in US and other areas. or
I didn't get the first part of your question.
to the big one?
Sorry?
Will it be a precursor to the big one, or is this the one which you asked, which all others have been waiting for?
I don't know why it should be a precursor. I mean, it's about time. Everything is, it's about time that all this happens. If you go and look at the inverted yield curve, for example, you know the story. So, what you are referring to,
Yeah.
the yield curve is still inverted, it is not de-inverted itself. So the recession story is really not played out. The higher for longer interest rates are only slowing down the housing market. So there are things happening. I mean, on the margin, there are a lot of things happening. So whatever would happen would be that next one. In fact, the similarity with 2008 is another similarity, which is more global, is that between 2000 and 2008, which is happening in a much tighter time frame to me right now, is that during that entire boom, India was doing really well. There was no problem, 2003 to 2008. But US had the same kind of stories. I don't know if you remember, if you were there at that point of time. Between 2000 and 2008, same stories. US economy slow, not growing that well. Market was going up. There were a lot of negative stories. Mark Faber was writing all kinds of stuff, and it went on and went on and went on till the housing bubble actually came to light. So in that sense, in the end, S&P was nothing but a double top between 2000 and 2008. Same top. Dow went slightly higher. Nasdaq did not go up at all. Now the same thing you compare between 2021 or 22 and now to 24. The Now of course some variations in indices, but S&P is almost a double top. Dow's gone higher. Of course Nasdaq has gone higher, but the Russell is not gone high at all. So Russell is like still at a 70% drawdown. The US banking index is still at a 70% drawdown. So huge divergences between internal sectors of the US. Okay, and a lot of these stories around, okay, but it's growing, but it's not growing, this can go wrong, can go right. This was the same kind of feeling between 2000 and 2008, and India had its own bull market going on while US was worrying about all these things. Still, those problems really came to the surface. So I think the environment is very similar. Only thing is that was a 7-year time frame, and this is like happening within 2 years, 22 to 24, and the same kind of thing happening in a very, very short period of time.
But a lot of people are comparing the current cycle, like the participation of top 7 tech stocks in US to the 99 2000 tech bubble.
Yeah.
And in 2007, tech in India was nowhere. I mean, it had come off hugely from 2000 top to 2008. But this is not the case right now. Tech is still very overvalued, as per your own submission also. So,
Hmm.
could we compare the current cycle to the 2006 to 8 one, or does it resemble more to the 99 2000 type of cycle?
No. So we will keep finding different similarities with different times, because
And
the whole saying is that history repeat, does not repeat, it rhymes, right? That is why we say that you will not find it exactly the same, but you will find references to things that have happened, and that is why we pay attention to them.
okay, great.
Yeah.
Thanks for that.
Now, on the sentiment side, I might add a few things to this conversation. See, we have to also look at what was the previous emotional point. So I would say that the previous emotional point was the Ukraine war top, right? So from the Ukraine war top, everything corrected, and there was definitely some fear, but which possibly has gone away. So from 2021 to 2023, 24 now, you look at the US market itself, I think both the Dow Jones and S&P would be hardly 5-6% away from that high. So nothing great has happened in these 2 years, but the only thing is the sentiment is so good, possibly everywhere, that things are looking so rosy. And when the things look so rosy, the time for accidents become ripe. That's all I can suggest here. But yeah, sentiment wise, I think last 2 years, even if you look at other markets, we've not gone anywhere. And you can look at Brazil, you can look at Russia. I think we are all there. And India is a market which has gone from 18,400 to 22,500 now. So that way, I think we have been the best performing market, and possibly time for some underperformance, and possibly other peers can perform better. I would say that possibly Dow S&P could perform slightly better than Sensex, because that's how the indicators are kind of right now set up. I think there could be definitely some outperformance in US, but EMs, I think especially EMs will get some punishment at least.
Yeah, Rohit. I think that's been a fairly good discussion between the bulls and the bears. And as usual, I think the opinion is divided, where I see Rohit and Sarvendra on the bearish side and Kishore Bhai extremely bullish. So, Rohit, do we take further questions or we call it a day?
So there's just one speaker left, Hiren, if he wants to. I will not add any more speakers now.
Yeah, sure.
हेलो सर, कैसे हो?
या हिरेन जी आप क्वेश्चन
सर ये मुझे ये पूछना है कि जैसे अब इधर हम लोग जो ट्रेडिंग करते हैं जो उसके अंदर गोल्ड और सिल्वर भी आता है. हेलो.
हाँ हिरेन जी, एवरीबडी कैन हियर यू, सुन सकते हैं आप, पूछिए ना.
तो गोल्ड और सिल्वर का हमारा ज्यादातर काम है और ये जो एक्सचेंज है तो 3:30 बजे बंद हो जाता है. इसके बाद हमारे हाथ में कुछ रहता ही नहीं है दूसरे दिन सुबह तक. तो कोई ऐसा सिचुएशन, कोई ऐसा सिस्टम गवर्नमेंट या सेबी, एनएससी या ये लोग चालू करे कि जिससे स्टॉक मार्केट भी अपने ओपन रहे और ये भी चालू रहे, गोल्ड और सिल्वर वाले भी चालू रहे. तो इससे क्या है कि कोई
24 आवर सट्टा चालू रहे.
नहीं सट्टा नहीं, 3:30 बजे के बाद जैसे अपन की हमारी जो पोजीशन है सिल्वर में, उसको अगर सपोज कोई कल को कोई प्रॉब्लम हो जाए तो कैसे काटेंगे
सर?
इसको?
आपका गोल्ड और सिल्वर मार्केट जो है वो तो रात को 12 बजे तक चलता है. खाली इक्विटी मार्केट 3:30 बजे बंद हो जाता है. गोल्ड और सिल्वर मार्केट का जो ट्रेडिंग होता है वो तो 12 बजे तक चल रहा है.
तो उसके लिए फिर वापस अलग से ये क्या करने का? तो उसके लिए
क्या करने का नहीं, मार्केट तो चालू ही है सर.
पर मेरा कहने के लिए मतलब ये है 3:30 बजे के बाद तो कोई सौदा डाल नहीं सकते ना अपन.
हिरेन भाई आपको एमसीएक्स में अपने ब्रोकर को बोल के एमसीएक्स में एक अकाउंट खोलना पड़ेगा. आप 11:30 बजे रात तक या 11:55 डिपेंडिंग ऑन जाड़े चल रहे हैं कि गर्मी चल रही है, 11:30 से 12 बजे तक मार्केट चलता है. बट आपकी जो दुविधा है बहुत अच्छी है. हमारी ये दुविधा आपकी तो अभी 11:30 और 11:55 की दुविधा चल रही है, आपको मालूम नहीं कि 3:30 के बाद मार्केट चलता है. हमारी तो दुविधा ये है कि 12 बजे जब मार्केट बंद हो जाता है और कॉमेक्स बंद होता है 2-2:30 बजे, क्लोजिंग सेशन में गोल्ड सिल्वर में इतना ज्यादा कभी कभी मूवमेंट हो जाता है कि इंडिया मॉर्निंग में एमसीएक्स में मेजर गैप अप या गैप डाउन हो जाता है और क्लाइंट्स को बहुत इसके पहले तकलीफें और प्रॉब्लम्स भी हुई हैं. तो मैं तो कहता हूं कि जब आप कमोडिटीज में आएंगे धीमे धीमे, और आज नहीं तो कल धीमे धीमे, आई थिंक जिस दिन एमसीएक्स को समझ में आएगा एमसीएक्स 2-2:30 बजे तक चलना चाहिए.
ओके, मतलब मैं ओके थैंक यू सर.
Yeah, Rohit, any view on gold, silver?
I'll let Sarvendra answer that.
Sarvendra, any view on gold, silver? Since you are extremely bearish on the market, do you see gold, silver performing?
Absolutely. No, it's my bread and butter. Gold, silver is my bread and butter. And the best part about that gold and silver is that you are pretty free. It's a global commodity. You are pretty free. Nobody comes haggling you. You said, where you said, why you said.
Yeah, the only problem
nobody can manipulate gold, silver. So that way, the analyst or the trader is slightly more at ease. Yeah. Sorry.
Yeah, the only problem in India is we don't have a spot market for gold and silver where we can take delivery on the exchanges. If that happens, I think gold and silver trading will be much higher than equity trading, because everybody understands.
It is there in MCX. You can take delivery, but the only problem is the brokers will not allow you to, and because the transaction costs are huge, then you will get paid delivery brokerage and this and that, and duties and this and that. So, and then if you don't want to keep it at home, you have to pay warehousing charges, and when you're keeping it somewhere else, you never know it is safe or not. So there's so many things to be addressed.
Yeah.
But yes, I agree. There should be a vibrant spot market, which currently is not. But the best way is still MCX. Hugely liquid. As far as silver and gold is concerned, among the top 3, I think now they would have already been top 2, or once I read that they were top 1 also. But safely to assume that they are the top 3 exchanges in the world as far as gold and silver is concerned. So absolutely liquid, absolutely low basis, 1 rupee, 1 rupee, 2 rupee, you'll get quotes on silver, gold.
Yeah.
So
Yeah.
I think
Sarvendra.
everybody should be, so let me take this spaces and tell everybody should be also looking at gold and silver as an asset class to be part of their portfolio. It can be
No, there is
5%,
only
10%,
derivative trading on.
20%.
No, Sarvendra, don't push people on MCX because there is only
No, I'm not
derivative
I'm
trading
not
on
pushing
MCX.
I am
There
not
is no
pushing anyone.
delivery.
No,
So
delivery you can go with.
we should
No, that
not
is why I was coming.
push people towards speculation
No,
in
I am not pushing
derivatives.
anyone to derivatives. Please don't take me wrong. I am saying you can go to your friendly jeweler or a bank, buy those 5 gram, 10 gram, whatever, 1 gram biscuits or coins and keep them. And keep them as part of your portfolio. Okay. So it could be 5%, 10%, 20% allocation. But trust me, one day you will thank me for that.
So great. Rohit, any closing remarks? Kishore, any closing remarks you want to make?
My view is buy stocks. Whether bull market is there or bear market is there are opportunities. There are companies which are doing extremely well, and they will give you a 50 to 100% return.
Every
Whether
year.
market Nifty goes up or goes down.
Every year.
Every year you will get good companies. Every market.
Yeah, I agree on that point.
I can possibly add, Palak.
Yeah. Please, Sarvendra.
So just for everyone, there is nothing meant for anyone here, but I just sharing the data that gold has bet every top index in the world, hands down, for the last 20 years, and Sensex for the last 11 years. So nobody should write off gold. Okay. And gold, I have not run now. This gives me again that one brainwave that let me just look at the top 100 Indian stocks and peg them to gold. I would still tell you that possibly, lot many would have not been able to outperform gold. Let's see. So we'll do that. But at the moment, I can tell you that a couple of major indices in the world have been beaten down by gold for the last 20 years, including Dow Jones.
So Rohit, any closing remarks and then we'll call it a day.
Yeah, I think I've made my case, and there was on Twitter. I'm seeing somebody ask me a question based on something I had said earlier related to inflation. That sometimes markets don't fall because inflation is high, and that is a fact. That we also look at an inflation adjusted data point with the index, and for between entire 2010 to 2020, the Nifty was underperforming on an inflation adjusted basis, which means it was not making new highs even though standalone it was. But after 2020 it has actually done that, and so somewhere inflation has played a big role. The thing is that if we allow inflation to persist, then surely it elevates markets and keeps them propped up, and therefore the ability of markets to come down gets reduced. But when we take a stance against inflation, then we actually slow down that train, right? That which is driving up prices. In fact, my sense is, somewhere earlier you were talking about that why that P ratio divergence occurred. Also, it occurred because if you look at the gap between revenue and earnings, that was actually expanding in the last 2 quarters. A lot of it has to do with price, apart from, of course, other what you can say gains due to efficiency. So it does play a role. Prices play a role in the cycle, and that can elevate things. But once you put a stop to price action, which is what bond yields indicate, and therefore we pay attention to that as well. That is when we cannot, keep discounting, increasing prices equal to increasing equity. So that's otherwise equity is the best risk hedge against inflation also. So that's the last thing for me to add. Rest I've of course given.
So great. Thank you everybody for joining us. We call it a day here. And if there is any big movement in the market in the next few weeks or months, we'll get back to spaces to discuss that. And we'll have Rohit, Kishore Bhai, Sarvendra, and we'll try to get few more people, prominent people. So thank you everybody for joining us. See you.
Yeah,
See you all.
thank you. Thanks,
Yeah.
Palak.
Bye.
Good night. Thank you.
Thank you.
Bye.
Thank you, Clark. Thank you.